down the rental profit calculation. I'm going to go over the formula to determine how much rent you're bringing in, what your expenses are going out, and how much profit is left over, and then calculating return on investment. So you can compare multiple rental properties when you're trying to decide between different properties, which one's the best one to buy that's going to get you the best return and make you the most money over the long run. So my name is Nick Foy. I'm the founder of Under 30 Wealth, a personal finance brand that teaches real estate investing, stock market investing, and other personal finance tips. Welcome back to the YouTube channel. If you're new here, make sure you're subscribed, as you're going to get a lot of value out of the videos on my channel covering real estate investing and personal finance. So today, let's get started talking about the basic formula that you can calculate net income on a rental property. So starting with the top line item, rental income, let's just put an example number up on the screen here. Let's just say we collect over 12 months, $10,000 of rental income. So our tenant was paying us, let's just say $833 a month times 12 months. So over a course of 1 year, we collected $10,000 of rental income. So that's the income that is going into our bank account every month that we've set up for this rental property. And then coming out of that bank account are different expenses to maintain and own this property. So one of the first expenses that's going to come out in the spring and in the fall are property taxes. So let's just say our property taxes are $1,500 coming out of the account. All right, then we've got insurance to make sure the property is protected in case of a fire or in case of some kind of crazy thing that happens that tears the property down and we'd be out the value of the property. So insurance we're going to have to pay for, that's maybe $1,000. So right there, we had $10,000 come in, we had $2,500 go out for property taxes and insurance. Now the next line item we're going to subtract out of the equation here is our maintenance and repairs that happened during those 12 months. So let's just say, for example, during that 1 year that the property was leased to your tenant happened to call you up and report that there was a plumbing issue with the toilet. Maybe the toilet started leaking water onto the floor from underneath the toilet, and you had to pay for a new toilet, which maybe cost $100, and you had to pay for a plumber to come out and do the repairs. So maybe that cost you $200. So in total, you had to spend $300 to fix and put a new toilet in. So that's going to be one of those repair and maintenance line items that's going to come out of the profit, the formula equation. Now, let's just say a couple months pass by and all of a sudden the garbage disposal stops working, and it happens to be an electrical issue and it clogged, jammed up. So you now have to have an electrician come out and mess with the electrical issue, and you had to buy a new garbage disposal. So that might be, let's just say, another $400. So at this point, you had $700 come out in total repairs and maintenance expenses. And let's just say that's all that happens the rest of the year. The tenant doesn't bother you, they keep paying rent. You just had the plumbing accident and you had the garbage disposal incident. So that would be it for repairs and maintenance, $700. And then from there, we could have another line item called capital expenditures. So this might be things that you have to do to the property that are big items, like replacing the roof, putting in a new furnace system, a new water heater. So they call these CapEx expenditures. These are things that make improvements to the property, for the systems, the structural things of a property. Now let's just say in year one we had 0 of these. We didn't have to worry about the roof this year. So that's going to be 0. Now, what I like to do sometimes in my profit formula is actually budget in an amount. So let's just say our roof is going to expect to last us another 10 years. Let's say when we bought the home, we had inspections done, and the inspector said, hey, your roof's probably good for another 10 years. Now, let's just say the cost of putting in a new roof might be $10,000. So to get a new roof installed, $10,000, and we've got 10 years of life left on this roof. So we could break that $10,000 up over the next 10 years, and we could start budgeting away $1,000 a year for the next 10 years. So when year 10 gets here, we already have $10,000 that we've already budgeted and set aside to cover this expense. That way we're not hitting that $10,000 expense all of a sudden in that 1 year when we need to replace the roof. Because in that year, if we're only making, let's just say $12,000 with that year in rent, we'd be almost wiping away our entire rent for the year from having to pay for the new roof. So instead, if we budget in a small $1,000 amount a year over those 10 years, we can kind of help offset the cost when it finally gets here and the roof finally fails and needs replaced. All right, and then our last line item here is going to be if we have financing. So if you have a mortgage, you're going to need to subtract the monthly mortgage payment. So at this point, we had $10,000 as our rental income. We had $1,500 for taxes, we had $1,000 for insurance, we had another $700 for maintenance. So we're already coming out $3,200 out of our account, out of that rental income. So what I like to do is I try to buy properties that can fit the 50-50 rule. So this means that you should expect about 50% of your rent to go towards your expenses, your operating expenses. So right now we're at $3,200. That's about 32% of our rent. So $3,200 is 32% of $10,000. So we're fitting in that 50% range quite nicely. We're not going over the 50% mark. Now, if we did budget in $1,000 for the roof, towards the roof repair down the road, that would bring our total expense right now to $4,200. So again, we're still falling in line with spending 50% or less on our operating expenses. All right, so now that we understand the 50-50 rule, let's talk more about that mortgage payment. So ideally, we want to have at least 50% of our rent left over to help cover the mortgage and the profits. So in this case, let's just assume we had a $400 a month mortgage payment on this rental property. So $400 a month times 12 months, we'd have $4,800 in mortgage expenses. So this comes in just under 50% of our rental income. And so that's why I try to break it in half. 50% of our rent should go towards our operating expenses. The other 50% should be left to cover the mortgage. So when we combine everything together at this point, we've got $1,500 for taxes, $1,000 for insurance, $700 for repairs, and then $4,800 for mortgage payments that we're paying back to the bank. So all in all, this comes out to $8,000, and that leaves us $2,000 of profit. So if we look at our rental income of $10,000 and we have $8,000 come out in expenses throughout the 12-month period, we're left with $2,000 as our net income from that property. So now we can start calculating our return by looking at how much capital we have invested in this property. So let's just say we put down a $20,000 down payment on the property, and we had taken out a mortgage for the remaining balance of that property, and that's why we're paying those $400 a month or $4,800 a year mortgage payments to the bank. So with the $20,000 down payment that we made on this property, that's our capital we have invested into the deal that we could be earning a return on if we would have invested it in other assets like stocks or bonds or gold. So that's the $20,000 we're using to calculate our return. So we made a $2,000 profit when it was all said and done after we subtracted out all our expenses. So we can divide that $2,000 profit by 20,000, and we're going to get a 10% return on investment. So if we invest $20,000 in order to make $2,000 a year in a return, that's 10% return on investment. So with that in mind, we can take the same formula, we can apply it to multiple different properties that we're analyzing at the same time. So if we realize another property might come back with maybe $3,000 of income at the end of the year, then that's going to be the better deal because we're making $3,000 instead of $2,000. So we're making an extra $1,000. And our return is now, instead of 10%, 15%. So we're getting a higher return on investment, and we're getting more cash in our bank account each year because this property, was producing better income, whether that's lower expenses or we were just able to collect higher rents from it. So analyzing using the formula, you can quickly start comparing properties to figure out which one's going to cash flow the best and have the best return on investment. Now, a few other things to note. It's not always how much the return on the rental income is. You also have to factor in the total return on the property. So one property might cash flow really well and might have a better rental income return, but it might be in an area that doesn't appreciate as fast in property values. So you might hold this property for 10 years and property values might only go up 50% over those 10 years. And so you're collecting rental income and you're making money on the property as it appreciates and goes up in value over the next 10 years. Now, property number 2 might be in a more demand, high growth area in your market. And so property values over 10 years might double or triple. So you got to factor in that, yes, you're making money on the rental income side, but maybe you're going to be making more money by holding on to it and getting that appreciation, that growth in value as property values increase. So you might be willing to take the lower return on rental income for the short term because in the long run, you're going to end up ahead on the price appreciation, on the value of the property going up. So for example, if you have a $200,000 property that's putting out the $2,000 a month in rent, and then maybe you have a $150,000 property that's putting out the $3,000 a month in rent. Now that $200,000 might end up doubling or tripling to $400,000 or $600,000 over the next 10, 15, 20 years. So you might still come ahead and have more wealth to your name by buying that property and taking the lower, $2,000 a year cash flow, as opposed to, taking $3,000 a year in cash flow, but only having a property that's worth, $300,000 after 10 years. So that's something else to figure in when you're investing in rental properties. Are you strictly going for what's the best cash flow, the best return on rental income? Or are you going for best overall return? If that's the case, then you can probably sacrifice a little bit on the rental income return if that means you're getting, a better deal on the appreciation side of things with property values and being a higher demand, high growth area. All right, so thanks so much for watching today's analysis video where we break down valuations and analyzing real estate and talking about the rental income formula, starting with how much rent we're going to bring in and subtracting out property taxes, insurance, repairs, maintenance, maybe some capital expenditures we want to budget for, like repairing a roof down the road, and then factoring out our mortgage payment. And whatever's left is our net income. That's the money we take home to our bank account, where our bank's going to grow and grow and grow, and we're going to eventually save up enough to reinvest and buy the next property with. Or we can withdraw that net income on an annual basis and use it to cover like retirement living. That could be a source of income. So with that being said, if this video gave you value, make sure you hit that thumbs up button to help this video out. Tell YouTube you gain value. It helps the YouTube algorithm. And in the meantime, you're subscribed to the channel. You're going to get notifications tomorrow when we come out with the next upload, as we're uploading videos daily. Thanks so much. I'll see you guys tomorrow.